Welcome to the deep dive. So you're here because you want to really get investing right,
Yeah.
without wading through tons of jargon or endless books.
Yeah, consider this your shortcut.
Exactly. Today, we're aiming to cut through all that noise. We're using insights from a pretty detailed blog article by Sai Sapone.
And Sai's got, well, quite the background. Over 20 years as a financial analyst and investor, boots on the ground experience.
Plus the academic side, too.
Oh, yeah. Bachelor's in finance, master's in economics. But what's really interesting, I think, is why he shares this stuff. It's not just about crunching numbers.
Right. It feels more about empowerment.
It is. It's about helping you think critically, make confident decisions, build financial strength, not just for yourself, but maybe to help others too. It's a mental challenge, he says.
And aligning money with values. I saw that mentioned. Like actually choosing where your money goes.
Precisely. Owning bits of businesses you believe in without having to manage them day to day.
Okay, so in this deep dive, we're covering quite a bit. The dynamics of business, fundamental analysis.
Research methods, managing risk, some basic finance terms everyone should know. Yeah, it's a broad overview, but it's important to say what we're not covering.
Good point.
This isn't about day trading or technical analysis, trying to predict tiny price jumps.
No get-rich-quick stuff here.
Definitely not. And nothing that's designed to just stress you out with constant trading.
So the mission today is really about building that foundational understanding. If you're new to investing, or maybe just need a good refresher.
Exactly. Focused on meaningful long-term approaches, not short-term speculation.
All right, let's jump in then. At its core, what is investing? How's it different from, say, trading or just spending?
Well, simply put, investing is putting your money to work with the expectation it'll grow over time. Earn more money.
Okay.
Sai makes a clear distinction. It's not day trading, that's speculation on short-term moves. And it's certainly not spending, where the money's just gone.
But there's risk involved, obviously.
Always. No investment is risk-free. But the key, and this is crucial, is understanding that risk, managing it, reducing it where possible. It's not gambling.
And Sai brings up this idea of it being meaningful, too. Voting with your money. What's that about?
It's about consciously choosing to support companies that align with your beliefs. So maybe you invest in green energy companies if that's important to you.
So your portfolio reflects your values.
Exactly. And think about the really wealthy individuals. Sai mentions Warren Buffett, Bill Gates, Ray Dalio.
Right, the big names.
They're investors. They built wealth over the long haul, not by flipping stocks minute to minute. It adds meaning to your dollars and ideally brings some peace of mind.
Okay, long-term focus, making money work for you. Sai also mentions reinvesting. What's the power there?
Reinvesting is basically taking the money your investments earn, maybe profits from selling something, or dividends paid out by a company, and just putting it straight back in.
To buy more investment?
Exactly. And this is what fuels compound interest. We don't need to get lost in the math, but the idea is your earnings start earning their own earnings.
The snowball effect.
That's the one. It accelerates your growth over time, absolutely vital for long-term investing.
Got it. So earn, reinvest, earn more on the earnings.
Right.
Makes sense. Now, we absolutely have to talk about risk. It sounds scary, but Sai breaks it down.
He does, and very practically. Risk management really boils down to how you allocate your assets, how you spread your money around.
Okay.
He gives this useful long-term risk spectrum on the low end: cash, CDs, money market funds, and importantly, index funds.
Index funds are low risk long-term.
Relatively speaking, yes, compared to individual stocks because they're diversified.
Yeah.
Then in the middle, maybe some sector funds, certain stocks, high end, most individual stocks, especially recent IPOs, cryptocurrencies.
And he says risk isn't just about losing money, right?
Correct. Risk is also about volatility, the ups and downs, how much the price swings around, which can be tough emotionally.
The stomach churn factor.
Exactly. And tied to risk is potential reward, which brings us to the risk-reward ratio. And Sai links this to beta and alpha.
Okay, beta and alpha. Sounds a bit technical. What do they actually tell us?
Well, if you compare an investment to the overall market, like using the capital asset pricing model, alpha is the extra return you get for the risk you took compared to that benchmark.
So high alpha is good. You're beating the market.
High alpha is the goal, yes. Beta measures how sensitive the investment's price is to the market's overall movements. A beta near zero means it doesn't really follow the market closely.
Which could mean more stability in your portfolio.
Potentially, yes. So ideally, you're looking for things with high alpha and low beta. Better returns, less tied to market swings.
Makes sense. Sai also mentioned comparing assets using correlation. How does that help manage risk?
Correlation tells you how closely two investments move together. For diversification, you want things that have low or even negative correlation.
So if one thing tanks, the other might hold steady or even go up.
That's the idea. Don't have everything moving in the same direction at the same time. It provides a buffer.
But Sai added a really important warning about these measures.
Yes, a critical point. All of these calculations, beta, alpha, correlation, they're based on past performance history.
And the past doesn't always predict the future.
Exactly. Markets change. New competitors emerge. Unexpected events happen. They're useful tools, but they aren't crystal balls.
Got it. Helpful guides, not guarantees. So when we're actually building a portfolio, what kind of things should we mix together?
Sai suggests a blend. Stock, mutual funds, bond funds, ETFs, individual stocks, maybe even a small bit of crypto if you're comfortable with high risk. Always keeping that risk spectrum in mind.
And the goal is diversification.
Absolutely. Look for those higher alpha, lower beta, low correlation assets, mix them up. And crucially, how much you put in each depends on your confidence and your risk tolerance.
More confidence, maybe more money, but inversely related to risk.
You got it. More confidence for the lower risk stuff, generally.
Okay, so we know what kinds of investments, but where do we physically or digitally hold them? Sai talks about different account types, like baskets with tax rules.
Right. These accounts are basically containers for your investments, and each has different tax implications. First up, IRA's individual retirement accounts. You manage these yourself.
And there are two main types.
Yep. Traditional IRA and Roth IRA. With a traditional, you usually get a tax break now when you contribute. Lowers your current taxable income.
But you pay taxes later.
Exactly. When you take the money out in retirement, usually after age 59 and a half, and you need earned income to contribute.
And the Roth IRA, that's the one people talk about a lot.
Right. With Roth, there's no tax break up front. You contribute money you've already paid taxes on. But the big advantage is qualified withdrawals in retirement are completely tax-free.
Wow, tax-free growth and withdrawals.
Yeah. Sai notes it's often the best choice for many, especially if you think you'll be in a higher tax bracket later.
Is there a limit to how much you can put in?
Yes. For 2025, the limit for both types combined is $7,000, plus an extra $1,000 if you're 50 or older.
Okay. Then there are the workplace plans, like 401k.
Right. 401k, TSP for government folks, 403bs, often for nonprofits or schools, 457 plans. These are employer-sponsored.
And the big draw is often the employer match, isn't it?
Huge advantage. It's basically free money your employer adds alongside your contributions. The contribution limits are much higher, too, $23,500 for 2025.
Can these also be traditional or Roth?
Many plans offer both options now, yes. Same principle. Traditional is tax-deferred. Roth uses after-tax money for tax-free withdrawals later.
So those are mainly for retirement.
Yeah.
What if you want access to your money sooner?
Then you'd look at a regular taxable brokerage account, sometimes just called a stock account or brokerage account, self-managed again.
The key word being taxable.
Exactly. The big plus is flexibility, put money in, take it out whenever. But any profits you make when you sell capital gains are taxed annually.
Are there different tax rates?
Yes. Short-term gains from assets held a year or less are usually taxed at your regular income rate. Long-term gains held over a year get preferential, lower tax rates.
What about losses?
Capital losses can be useful. They can offset capital gains. And if you have more losses than gains, you can usually deduct a certain amount against your ordinary income each year, typically if you itemize deductions.
Sai also quickly mentioned accounts for kids, education, stuff like UTMA, Coverdell, 529s.
Yeah, those are specialized accounts. Custodial accounts, UTMA, GMA for minors. Coverdell ESAs are flexible for education but have low limits. 529s are less flexible but popular for college savings. Even Roth IRAs for kids with earned income.
Lots of options. He even suggested a fantasy account, like a spreadsheet.
Yeah, just tracking hypothetical investments. Great way to learn the ropes without risking real cash.
Smart. So the bottom line on accounts, you open them with brokers like Schwab, Fidelity, Vanguard, etc. You can have several types with one broker. And most accounts can hold various investments, though maybe with some limits.
That's the gist of it.
Okay, let's shift gears. We need to understand the language. Basic finance terms. First up, supply and demand. We hear it all the time.
Absolutely fundamental. It's the relationship between how much of something is available supply and how much people want it demand.
And how do they relate to price?
Generally, supply moves opposite to price, higher price. More people want to sell, so supply goes up. Demand usually moves with price, but often we think of it the other way. Lower prices tend to increase demand.
So if everyone suddenly wants, I don't know, a specific stock, demand shoots up.
And the price tends to rise, yeah. If supply floods the market, say too many houses for sale, prices tend to drop if demand doesn't keep up.
Tsai used examples like stocks, houses, toilet paper, wages even.
Right. It's a powerful force. But he also warned against thinking they always affect each other instantly or perfectly. It's complex.
Okay, supply and demand basics check.
Yeah.
Now, a share of stock, what are we actually buying?
You're buying a tiny piece of ownership in a publicly traded company. It's equity, not debt. The company doesn't owe you repayment like a bondholder.
And usually, we're buying from another investor, not the company.
Most of the time, yes. On the open market, you buy from whoever is selling. The company itself mainly sells shares during an IPO, the initial public offering.
Which is how they raise money initially.
Exactly. They sell those first shares to the public to raise capital for growth, research, whatever they need. Investors become part owners.
And why do we, as investors, buy stock? What's the upside?
Several reasons. Hope for future profits and earnings growth, which makes the company more valuable. Potential dividends, getting a share of the profits. Lower initial investment compared to buying the whole company.
Right. Much easier to buy one share than the whole thing.
And the expectation you can sell it later for a higher price. Good company performance usually leads to higher demand for the stock, pushing the price up.
Tsai explained the stock market works like an auction system. Can you unpack that?
Yeah, think of buyers putting in bids, the highest price they'll pay. Sellers put in asks, the lowest price they'll accept.
Like an auctioneer calling prices.
Sort of. The best bid is the highest current bid. The best ask is the lowest current asking price. A trade happens when they meet, when someone's willing to pay what someone else is asking.
What's the bid-ask spread?
That's just the difference between the best bid and the best ask. And Tsai makes a key point. The supply of shares at any moment is fixed. So price is heavily driven by demand, which is influenced by, well, psychology and sentiment.
Which can lead to bubbles sometimes. You mentioned that.
Yeah, we'll definitely talk more about bubbles later, when excitement outpaces reality.
Okay, so auction system drives the price. Now, we always see the price per share. Is that the best measure of value?
Tsai argues strongly against relying only on price per share. It's visible, sure, but it's a poor way to judge a company's actual worth or compare companies.
Like judging a house just by price per square foot doesn't tell the whole story.
Exactly that analogy, misleading on its own.
So what's a better metric for overall company size or value?
Market capitalization, or market cap. Very important. It's simply the number of outstanding shares multiplied by the current price per share.
So the total cost to buy the entire company at today's price.
Pretty much, yeah. It gives you a much better sense of the company's overall market value, helps you compare if one company looks way more expensive than another relative to its size. Tsai linked to Yahoo Finance for T, as an example.
Okay, market cap is key. Now, money coming in versus money capped. Revenue and earnings.
Right. Revenue or sales is the total money coming in the door from selling stuff or services. Top line number.
And earnings.
Earnings or profit is what's left after you pay all the bills, costs, expenses, interest, taxes. The bottom line, there are different types like gross profit, EBITDA.
Whoa, EBITDA.
Yeah. Earnings before interest, taxes, depreciation, and amortization. It's just a way to look at core operational profitability, taking out some non-cash expenses and financing costs. Then there's EBIT, and finally net earnings, the real profit.
Got it. And the PE ratio, price to earnings, uses that earnings number, right?
Correct. PE is price per share divided by earnings per share. Super common ratio. It helps you gauge if the stock price seems high relative to the actual profit the company makes.
A valuation measure.
Exactly. You can compare PE ratios between similar companies or against the market average. Roughly, it suggests how many years of earnings it might take to pay back the share price, best case scenario anyway.
And dividends, where do they come from?
Dividends are cash payments companies make to shareholders, usually paid out of profits or accumulated reserves. Sometimes, though less ideally, funded by debt.
Okay. Tsai also mentioned PS ratio, price to sales. When would you use that?
Price to sales, market cap divided by revenue, is useful when a company doesn't have earnings yet, like a fast-growing tech company that's reinvesting everything and not showing a profit.
So you compare its price to its sales instead.
Exactly. Another valuation tool, especially for growth companies or those with fluctuating earnings.
All right, those metrics help with individual stocks. But what about packaged investments? Mutual funds and ETFs. Let's start with mutual funds.
Okay, a mutual fund pools money from lots of investors. A professional manager then invests that pool in a bunch of stocks, bonds, or other assets.
So instant diversification.
That's a key benefit, yes. Plus professional management. The downside is you pay a fee for that management. And the price, the net asset value, or NAV, is only calculated once a day after the market closes.
So you place your buy order, but you don't know the exact price till later.
Right. You invest a dollar amount, and they figure out how many shares that buys at the end of day NAV. Psi linked to a Fidelity Fund example.
Okay. How are ETFs exchange-traded funds different?
ETFs are also pooled investments holding lots of assets, like mutual funds. But they trade on stock exchanges during the day, just like regular stocks.
So you can buy or sell them anytime the market's open.
Exactly. They also have an NAV, but their price fluctuates based on trading activity. Advantages often include lower fees and better tax efficiency than many mutual funds.
Any downsides?
Well, because they trade live, the market price can sometimes drift a bit away from the actual NAV of the underlying assets. You might pay a slight premium or get a slight discount. Psi gave an ARK Invest fund as an example.
So more control, often cheaper, but watch the price versus NAV. Got it. Now, indexes like the S&P 500, what are they telling us?
A market index is just a sample of stocks used as a benchmark, a snapshot to gauge how a particular part of the market or the whole market is doing. The S&P 500 tracks 500 large U.S. companies.
And we can invest directly in those through index funds.
Yes. Index funds, either as mutual funds or ETFs, are designed to simply mimic the performance of a specific index. They buy the same stocks in roughly the same proportion.
You get broad diversification automatically.
Exactly, and usually with very low fees. Psi considers them a cornerstone for most long-term portfolios. Lower long-term risk than picking individual stocks, though still subject to short-term market fluctuations.
What about sector funds?
Similar idea, but they focus on just one specific industry sector like technology, healthcare, finance, energy.
More concentrated then.
Right. Moderate long-term risk, potentially higher short-term volatility because they depend on that one sector's performance. Psi listed some Fidelity sector funds.
Okay, so we have index funds, sector funds, then individual stocks, which are higher risk.
Definitely higher risk. Your fortune rests on that one company.
No.
And then even higher risk things like cryptocurrencies, options, warrants.
The highest risk category.
Generally, yes, due to volatility complexity. And Psi makes a great point. Your own risk tolerance is personal. It often decreases as you get closer to retirement. He even shared his own allocation as an example.
A good reminder, it's not one size fits all.
Oh,
Okay, we know the what and the where. How do we decide which specific investments? Research is key, Psi says. Where do we start?
straight to the source.
It's-
The SEC, Securities and Exchange Commission. Website is www.sec.gov.
The official government agency.
Exactly. They protect investors. Their filings are the primary unfiltered information. Psi stresses reading news critically, but doing your own homework using these filings to form your opinion.
He mentions specific SEC forms. Let's go through the important ones. 10Q.
That's the quarterly report. Detailed financials, business segments, markets, risks. Super important.
And 10K.
The annual version of the 10Q. Even more comprehensive. Psi calls these the most comprehensive sources for company info.
Okay, 10Q quarterly, 10K annual. What about the 8K?
8K is for current events, big stuff. Material impacts mergers, acquisitions, executive changes, things investors need to know now.
What about Forms 3 and 4? Something about insiders.
Yes, Forms 3 and 4 track insider buying and selling. When executives, directors, or major shareholders buy or sell any amount of company stock, they have to report it quickly.
Can be a useful signal, maybe.
Can be. Then there are the SC13G and SC13D forms. These get filed when an outside investor buys up a big chunk, more than 5%, 13G, or sometimes 10% with active intent, 13D. Shows big players making moves.
And the S1.
That's the big one for IPOs. The initial public offering prospectus, filed before a company goes public, full of details on the business, financials, risks. And side notes, all these SEC filings are free.
Free official data. Great. Lastly, the 13FHR.
Ah, yes. This is fascinating. Institutional investment managers handling over $100 million have to file this quarterly. It shows their long positions, what stocks they own.
So you can see what big hedge funds, pension funds, endowments are holding, like Harvard's endowment or Citadel.
Exactly. Hedge funds like Melvin Capital, Citadel, Point72, big mutual fund families, university endowments. You can compare their holdings quarter to quarter, see what the smart money is buying or selling.
Wow, okay. So SEC.gov is ground zero for research. What other tools did Psi suggest?
He mentioned Yahoo Finance. Good for quick summaries, standardized financials. It's free, but the data can be delayed, maybe a quarter behind SEC filings.
Still useful for a snapshot.
Definitely. Then Seeking Alpha, good for deeper fundamental analysis, dividend info, different contributor viewpoints, though you have to judge the quality.
And investing.com.
That gives you a broader market view. Stocks, bonds, commodities, crypto, global markets, helps see where money might be flowing overall. And of course, Bloomberg, Google for general news and research.
So, a toolkit.
Oh.
But the SEC is the gold standard. Now, fundamental analysis, what's involved there?
It's really digging into the company itself, analyzing the financial statements, income, cash flow, balance sheet, understanding the business model, what do they sell, who are their customers, suppliers, partners, where do they operate?
Looking beyond just the stock price.
Way beyond. It also means analyzing risk lawsuits, regulations, competition, how much debt they have, can they get financing?
Sai also mentioned the growth versus value trade-off. What's that distinction?
It's about different investing styles. Growth investors look for companies poised for rapid expansion, high revenue growth, even if the stock seems expensive now.
Betting on the future.
Right. Value investors look for companies that seem cheap now, based on metrics like PE ratio or book value, maybe because they're out of favor or overlooked.
Looking for bargain.
Exactly. Sai used a rental property example. A pricier property might still be a better value if its potential rental income, like earnings, is much higher, giving it a better return profile, like a lower PE.
So it's about balancing potential growth with current price. Okay, size information hierarchy. Where should we focus?
Tier 1, original sources. That means SEC filings first and foremost.
Undiluted information.
Precisely. Tier 2, reputable news reports. Bloomberg, Reuters, Wall Street Journal, professional analysis. Tier 3, social media word of mouth, used with extreme caution.
Got it. Start at the top. His overall strategy seems to be see what the smart money is doing via SEC filings, then do your own deep dive.
That's a great summary. Use the institutional filings as a starting point, maybe for ideas, but then do your own fundamental analysis to really understand the company and form your own conviction.
He recapped the key SEC docs, Forms 3, 4 for insiders, SE 13GD for big outsiders, 13F for institutions, S1 for IPOs, 10QK for financials, and tools like risk assessment, beta alpha, financials, diversification, correlation.
All essential parts of the toolkit.
Okay, so you've done the research, you've picked an investment, you understand your account. Now, actually placing the trade, he revisited the auction system.
Quick recap. Your buy order is a bid. Your sell order is an ask. Trade happens when best bid meets best ask.
And there are different order types.
Right. A limit order lets you set your exact price. Buy at $50 or less, sell at $60 or more. It only executes if the market hits your price.
What about market orders?
A market order says, get me in or out now at the best available price. Executes immediately, but you don't control the exact price.
Could be slightly different than you expected.
Could be, especially in fast markets. For selling, there are also stop-loss orders triggers a market sell if the price drops to your stop level. And stop-limit orders triggers a limit sell if the price drops.
A bit more control with the stop limit.
Yes. And he mentioned settled cash. Just make sure funds from a sale have cleared before you try to use them for a new purchase. Broker rules.
Phew. Okay. This has been incredibly comprehensive. We've gone from what's investing all the way through research, accounts, terminology, placing trades, all based on Sai Sapom's insights.
It's a lot, but it really builds that essential foundation. Understanding risk, diversification, the importance of primary source research like SEC filings, thinking long-term.
Yeah, the key takeaways seem to be know what you own, manage your risk, do the homework.
Absolutely. And remember that idea of investing being a long game, about building wealth steadily and maybe even aligning your money with what you care about.
Which leads perfectly into a final thought for you, the listener. Reflecting on this deep dive, especially that idea Sai raises of voting with your money. What values or causes are important to you? How might you want your investments to reflect those things?
It's a powerful question to think about as you move forward.
Definitely something to ponder.